Let's turn our focus to the US now. I want to start on this column by Mohammed Al-Arian for Bloomberg View. He's, of course, noted economist and advisor to Allianz. He talks about the flatter yield curve. It's not completely flat yet in the US, but it's, we're talking 55 basis points or thereabouts. He gives 8 reasons why it may not be an indicator of bad things to come. Is it?
No, I think we would agree with that analysis that in this particular case, it is not signaling a recession. In fact, our view is very firmly that this expansion has quite a lot of room to run, even though it's been going on for quite a long time already. And I would say people tend to forget because we haven't been in a normalization cycle for some time, but it's not unusual for the yield curve to flatten initially when a central bank embarks on a normalization course. And as long as it's happening from the short end, primarily from the short end, which is what we've seen, there's nothing particularly alarming about it in our view.
Now, we did see the 10-year yield back up to 2.49, in fact, it topped 250. But as Ian Lincoln of BMO was pointing out earlier this morning, that's a far cry from 2.64 that we got to this time last year because there was so much hope. Where does the 10-year yield go in 2018?
So we think it goes higher, but not by a whole lot, and that's largely due to, frankly, global factors, where there's still a lot of appetite for long-dated, safe assets like U.S. 10-year bonds. We have the ECB and the Bank of Japan still in full steam, almost full steam expansionary mode, buying a lot of government bonds, depressing yields in their own parts of the world. And so that's, again, driving a lot of demand towards U.S. Government bonds. And that demand isn't going away. It's there for structural reasons. And so, sure, as inflation comes back and growth remains very strong, or perhaps even accelerates, we're going to see a bit of upward move in the long-term end of the curve. But in our view, not a whole lot.